back, students. As we were continuing with our series of the subject of economics, so we have done various topics, multiple topics, which are listed in the platform. I hope you all are enjoying and liking it. So last video was about taxation. Last the last two videos were about taxation. So similarly today also I have brought another topic of taxation, that today in this video we will look into the different examples of direct taxes, like what is income tax, corporate tax, securities transaction tax, and dividend distribution tax. Okay, before that, once again, let's recall what was a direct tax. Direct tax was a tax where the impact of tax and the incidence of tax uh, was at the same point. Means it is the point or person or any institution upon which the government imposes the tax, that is the impact of tax, is the ultimate bearer of the tax burden, that is the incidence of tax, lies on the same point, person, or institution. Hence, those taxes are known as direct taxes. So, income tax here, the income tax is a direct tax. Now, what is this income tax? We have to see this income tax is levied on whom? Income tax is levied on individuals. Income tax are levied on businesses like sole proprietorship. Sole proprietorship. What do we mean by sole proprietorship? It is the business where there is only one owner, or Hindu undivided family, in short HUF, where it is a generational business, one after another generation of a same family carries on the business without getting the business divided among the descendants of that family members. But but income tax is not levied on company, not a company. Income tax is not levied on company, because this question can come in your examination, ki income tax is levied on which of the following, or income tax is levied not levied on which of the following. So remember, income tax is not levied on a company. All right. Now, this income tax is levied on the income of an individual, sole proprietorship, or Hindu undivided family. This income tax is based on certain tax slabs. That means different tax slabs or income slabs. You can also say as income slabs, which means the different income range attracts different taxes. Say for example, Say for example, if your income is from 0 to say 3 lakh, let's go by the old tax regime, 3 lakh, then your tax rate will be nil. And if your tax is more than 3 lakh till 5 lakh, then you have to pay a 5% of tax. If your income is more than 5 lakh up to 7 lakh, you have to pay a 7.5% of tax, like that. So as much as your income will increase, your tax rate will also increase. So we can say that income tax is a progressive uh, progressive tax. Income tax is a progressive tax. That means as your income rises, income tax also rises. Now, as the company is not liable to pay income tax, hence the company is liable to pay a corporate tax. Who pays a corporate tax? Corporate tax is not paid by any other business other than the companies, the corporations. In corporate tax is not paid by sole proprietorship. Corporate tax is not paid by partnership firms. Also, okay, you can include here the partnership firms also needs to pay income tax, but partnership firms do not pay corporate tax. Neither Hindu undivided family pays corporate tax. All right. Now, this company, based on its turnover, based on its turnover, or profit, it has to pay a amount of tax that is known as corporate tax. All right. Now, interestingly, both this income tax and corporate tax are governed by the Income Tax Act. By the Income Tax Act. There is no separate act for corporate tax. Now let's come to securities transaction tax. Now, what do we mean by these securities? These securities means bonds, shares, or stocks. Okay, any financial assets, any financial assets are your securities. Now, when these securities are held and sold at profit, when you sold your you sold your shares or stock to some other person, you have sold your bonds at to other person at a profit. Price that you have purchased was the price that you have purchased, and the price at which you have sold, it was higher. So hence you made the profit. So you have to pay a securities transaction tax. All right. Now, next is the dividend distribution tax. Now, what is this dividend distribution tax? Now, first of all, let's understand what we mean by dividend. Dividend means dividend means part of profit. Dividend means part of profit, and dividends are distributed to dividends are distributed to shareholders. Dividend are distributed to shareholders. That means it is something related to again company, because a company has shareholders. That means when a earns a profit, company earns a profit, this profit is divided among its shareholders. This part of profit is known as dividend dividend. Okay, dividend. Now, as dividend is an income, so what it is, that before the distribution, when company will declare distribution of dividend, from this profit the company had to pay a DDT, that is dividend distribution tax. Ki before the company distributed its profit among its shareholders, the company had to pay dividend distribution tax firstly to the government, then share. Now, after these individuals receive their dividend, again from this dividend they had to pay the income tax. Now you will see this profit is ultimately dividend. From this profit, dividend distribution tax was also paid. Again from this profit, income tax was also paid. That means the government gets two times two times taxes from the same amount. So there made certain changes ki from only one income there will be only one tax. So government abolished the dividend distribution tax. So in today's taxation system in India, there is no tax called dividend distribution tax. It is abolished. Only the shareholders have to pay the tax on their dividend as income tax. All right. So do remember, this dividend distribution tax is abolished. All right. I hope these topics are clear. Then stay tuned in this platform to watch more videos of mine. Thank you so much and best of luck.